Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com. Want to talk to you today about how do points work. So you may have heard that term kicked around a little bit, especially a little bit more now that interest rates have been on the rise, is you can use points to buy down your interest rate. So what is a point? Point is a percentage of the loan as a fee to buy down the interest rate. The most common one you'll hear is 1 point, which is 1% of the loan. But you can also have a half point, which is 0.5% of the loan or a quarter point. Now, I'd also say a lot of times it's never exactly zero. It's never exactly 1 point. Sometimes it can be 1.148 or 1.268 or 1.4. So I wanted to show you a little behind the scenes. Not a lot of people see how this part of the business works. So you get a little inside information on how we calculate what the discount point would be or what interest rates are available at any particular day. So what I'm going to show you is a basic idea what a rate sheet looks like. Now, this may not be your specific situation. This may not be the rate available today. This video is being recorded, so it could be a totally different time that you see this video where rates can be totally different. But the same kind of numbers play out no matter what the market's looking like. So let's jump right into this. Let's say the purchase price is, let's go with $450,000. Let's say the appraisal is the same thing, purchase price. So this is a purchase, not a refi or a cash out. Let's go with 90% financing, which would be 405,000. Let's go with a credit score, let's say 741. Let's go primary residence. So you can see there's primary residence, second home investment property. This changes the interest rate. Whether it's a single family condo, townhome, manufactured home, that changes the rate. Whether it's a multi-unit, whether it's what state it's in, what county it's in. I mean, all these boxes can change the interest rate that you're getting on the loan. So this just gives you a basic idea of how this works. So let's go ahead and submit that basic scenario. Again, this may not be the rates that are available the day you actually look at them. So now let's just go down. Let's just click the first loan here and see kind of what pulls up. Okay, so let's go down here. You can see these numbers here. This is the interest rate. These are the points it would require to buy down that particular interest rate. So let's kind of hone in right here. We've got 6.875 is a cost of 0.859 versus 6.625 is a cost of 2.420. So here's the differences. So these two are the differences between those two interest rates, essentially buying it down. And you can see that it's never exactly zero. It's always somewhere kind of in between. And sometimes there's a big jump. Sometimes there's not much of a jump at all. So it's really important to look at the full rate sheet and not just at a specific rate, because very little money could bump you down to the next tier, or very little money can raise it to the next tier. So now let's take a look at this real quick. So I pulled up the numbers. So that's the difference of the mortgage payment in that scenario. 6.625% would be a payment of $25.9327. Now that's just the principal and interest on the loan. That doesn't count taxes, insurance, mortgage insurance, all the other things. We're just kind of comparing how these points actually work. Then if you go to the other rate of 6.875%, you can see the difference is $67.30 per month. Now for the life of the loan, that's $24,228 for the entire 30 years. But the cost difference is $2,272 more upfront. So I always like to look at what the break-even point is. So if you take the points and divide it by the payment, it would take you 33 months or 2.81 years, so just shy of 3 years, to earn back the $2,200 it cost you for the points. So until you get to that point, you're not saving any interest or money on the loan. You're just breaking even until you get to that particular point. Then after that point, if you minus the $2,200 off of the 24 for the whole life of the loan, yes, you're going to save money. But if you're not going to keep the loan for 30 years, if you're not going to keep the property for that long, if you're going to upgrade or downgrade or sell or move out of the area, I mean, most people keep their home between, the average right now, I think, is between 5 to 7 years. I have seen that number ticking up a little bit, maybe getting closer to 10 years in some markets, but very rarely is it all 30 years. So if that's the break-even point, you just want to know that number to know if it's worth paying the points or if it's just better to take the slightly higher rate and pay a little bit more, but not have as much out of pocket. Now you can see those numbers will play out on all of these numbers over here. So you want to run the math on whether it makes sense to jump up to the next tier. But I would tell you most of the time, every time I've run the calculations on this stuff, it's usually about 3 to 5 years, somewhere in that ballpark of where the points break even on the payment reduction. So I hope you found this information useful. If you have any comments, questions, or concerns, please put it in the comments below. But I wanted to give you kind of an idea of how points work, when you should buy down the loan, and just a little behind the scenes on all the things that factor into what determines an interest rate. So if you're looking to buy a home, looking to refinance a home, I do loans in Utah and Nevada. So check out my website at brianbolton.com. There's a little scheduler right there. You can download my mobile app and apply right there through the website or through the mobile app, or just set an appointment and we'll run these numbers for you. There's no cost or obligation to find out what you qualify for. So I'd love the opportunity to work with you. So hope you found this information useful, and let me know where I can answer any questions you might have. Thanks again.